Hey everyone, welcome back to another video. In this video, we will be looking ahead to the trading week beginning on July 13th. Before we look ahead, let's do a quick recap of what happened last week. So last week, SPX had an expected move of about 98 points, and well, we moved about 98 points. The upper end of the expected move was supposed to be around 75.81, and SPX closed at 75.75. Just about 6 points shy of the expected move. Actually, intraday we tagged just a little bit closer to that level, missing it just by a couple of points. So we're now about 2 weeks into the month of July, and so far both weeks have hit the upper end of the expected move. Last week in the video, we talked about how July is one of the most bullish months, and so far it has displayed exactly that. Last week we hit the upper end of the expected move. This week we've hit the upper end of the expected move. It's funny actually because on Wednesday for a while it was looking like we were going to break down and hit the lower end of the expected move. We missed it just by about maybe 40 points, give or take. But obviously there was a huge turnaround on Wednesday, and that continued into Thursday and Friday, and we went from almost the lower end to the upper end of the expected move in just a couple of trading sessions. So far, July has been exactly as we expected. We're not seeing the same momentum that we did in April and May, obviously. We're not seeing crazy 2 or 3 standard deviation moves, but I think that's the perfect reflection of July. Low volume trade, kind of the middle of the summer, and things are just kind of grinding higher. If you're watching the market closely this week, it was mostly just a grind higher. There wasn't really just huge explosive moves and where the move just continued on and on with a lot of momentum. It was really grindy, really choppy, but there was just upside bias. These candles kind of look maybe a little bit bigger than they are. Um, it just kind of felt like we're just grinding 20, 30, 40 points higher at a time, and we eventually made it to the upper end of the expected move. So I think that's a perfect reflection of what July is supposed to be, and the market's doing kind of what we expected. All right, so looking ahead to next week, we see that SPX has an expected move of about 88 points. Last week, the expected move was 98 points, and the week prior was 120 points. So we've seen a trend as we've entered the summer months of the expected move getting gradually smaller and smaller and smaller. We'll talk about that more in detail as when we look at the VIX, but the short-term implied volatility for this week, uh, as of recording this, is sitting at about 12. I know at one point on Friday it was actually at 10, so we're almost to a single-digit print on the short-term IV. So the upper end of the expected move is around 76.64, and the lower end is at 74.68. If you'll actually notice, I want to talk about the lower end of the expected move first. That 74.68 level is almost exactly the low that we made on Thursday. So that kind of shows the upside bias that the market has, where the market is kind of expecting the low, or if we went down, to only go down to about Thursday, but the expected high takes us well above the current all-time highs. So the current all-time highs are at 76.20, and we're expecting 76.64 on that. So just something to keep in mind. The upside bias continues. It is July after all, so don't be surprised if SPX just very quickly takes the 76.64 level. We can kind of see we've built some momentum from the swing low here, and it's been almost a straight line higher so far. We also closed just about at the highs of the day on Friday, and usually that pours into Monday, but we'll see where things open Sunday night on futures and what kind of looks like on Monday morning. But don't be surprised if the 76.64 comes pretty quickly. Now, one thing about the 88-point expected move that has me worried is that the implied volatility can only contract for so long before it explodes again, right? We can kind of see IV was low here and then we exploded. There were other periods of time, last year, even somewhere around the holidays, where we see IV contract and then we see an explosive move, generally to the downside. But that's a point for another day. So I know in theory that a 1 standard deviation move has a 68% probability, right? And a 2 standard deviation move occurring in theory has a 5% chance. But I feel like in reality, those numbers don't always align with the theoretical values. So think of it this way, right? When we have a 150 or 200 point expected move, a 2 standard deviation move would mean SPX has to move 300 or 400 points. Now, how often do we see SPX moving 400 points in a week? Almost never. maybe once in a couple of years, a few years, right? If something really crazy happens, Liberation Day, etc., COVID, for example. But, take a look at this week now. So 88 points is the one standard deviation move. The two standard deviation move would be only 176 points. Now, SPX moves 176 points off the back of a tweet sometimes, right? We see here this candle was 240, 250 points, 150 points. This gap down 150 points. So 176 points being the two standard deviation move doesn't even seem that high of a number, right? We had days, like I said, just a few weeks ago where SPX was moving, those numbers in no time. So in theory, yes, there's a 68% chance that we only move 88 points, but something tells me that with everything going on in the world right now, 88 points for the entire week just seems off. I know that's what the market expects, right? If you're a market theorist, right, that's the one standard deviation move, and 68% of the time we're within that bound. But 88 points just seems a little too low for me. So if you're selling premium, if you're doing strangles out there or straddles, whatever, just be careful. I think now is probably not the time to be selling that premium. And 88 points to me just seems a little low. So just beware of maybe some volatility surprising us and coming into the market, and all of a sudden we're moving 150 points. So, we'll see how this week goes, but just something to keep in mind. All right, and as discussed earlier, I want to quickly take a look at the VIX. So VIX closed the week at 15.03, just barely hanging on to that 15 level. And we know, so this tracks 30-day implied volatility, sitting at around 15 right now, and the weekly IV was around 12. So we can see VIX is at some of the lowest levels we've actually seen all year. We have to go back to very early January, right out of this holiday break, to see VIX this low. This 17 level is kind of the pre-war level, I like to say, right before everything kind of began with Iran. So we're definitely well below that. We're towards the lower end of our historical range, this gray box here. So like I said, we're seeing VIX at levels not seen since almost the holiday time or very early this year. Um, Kind of expected, I guess, right, for the summer months, VIX volatility, etc., volume, momentum is kind of on the lower side. But again, with everything going on, it just seems weird that VIX is so low. Um, Even the geopolitical stuff aside, right? We've seen days where some of the big market movers like SanDisk, Micron, Nvidia, AMD are moving 10, 15% to the downside, right? We've seen Nasdaq sell off, 7, 800 points, 1,000 points, and VIX really hasn't moved. Um, it just seems weird with everything going on that VIX just continues to collapse. I don't know who's selling premium instead of buying it at these levels, but that's just what the market's showing us. So one thing just for this week, if you're gonna watch the VIX, just watch how it behaves if SPX continues to push higher. So last week, SPX pushed higher, and we saw VIX collapse with it. Um, but in January and February, when we were seeing SPX make new all-time highs, VIX was kind of creeping up. So if we start seeing that happen again, where VIX either kind of just bottoms off and hangs on to this 15 level, or even starts pushing back towards 16, 17, or maybe 18, but SPX continues to push higher, I think that's kind of a warning sign of maybe some more volatility or downside price action coming. So I don't want to get too ahead of things, but just keep an eye out on VIX. If we start getting back towards 17 this week, even though SPX made a new all-time high, I think that'll be a sign of things to come. All right, so really quick, another trade of the week idea. So last week we looked at something really similar. Obviously, SPX closed right at the outer end or upper end of the expected move. So if you held on to that trade by Friday, you probably didn't make any money. But middle of the week, Wednesday, Thursday, you probably could have closed that trade and doubled your money. So sometimes the trade comes down to just trade management and exiting at the right time. For this coming week, I'm looking at a similar diagonal, but this time instead of covering the expected move, just kind of going off of what the last 2 weeks have looked like. I'm trying to aim for the upper end of the expected move. So from earlier in the video, if you remember, the upper end of the expected move was like 76.64. The closest strike to that is the 76.65. So we'd be selling the 76.65 call for this Friday expiration, which is July 17th, and then we'd be buying the 76.70 call for the following Monday, July 20th, $5 wide spread, a $2 debit, and you're looking at a max profit of about $2,000 on a one lot if we close right at the upper end of the expected move again, right? Like we have for the last couple of weeks. So you're risking $2 to possibly make, 20, or you're risking 200, dollars to make $2,000 on this trade. So that's kind of the trade of the week. If this stays at around $2 debit, if we don't open up crazy on Monday and this is still hovering around this, maybe this is something to consider. Just a small risk, right? So if we completely collapse lower, you lose that $2 debit that you paid. If we go like 2 or 3 standard deviation move, right? Maybe you can lose like $460. But just given how things have been going in the market lately, um, you know, expecting us to go back to the expected move, to the upper end of the expected move, is maybe not a bad idea. So if we just quickly look at the break even levels of this trade. So on the lower end, we would need SPX to close above 75.78, which is right where we closed on Friday. So as long as SPX is up just a little bit for the week, this trade should make some amount of money, and the upper bound cutoff would be as long as we remain below 77.33. So we know the upper end of the expected move is 76.75 or 76.65. So we would need almost like a 1.5 standard deviation move for this trade to lose money to the upside. So something to track. Just throwing that out there. Not financial advice, obviously. Do your own research and place trades based on your own risk tolerance, but just something I wanted to throw out there. All right, and that does it for this week's video. Thanks again for tuning in and watching along. This is about the third video I think that we're doing, so I've gotten some feedback, and I appreciate you guys, giving feedback on the video, and as we continue to grow the channel, hopefully, we'll take feedback, maybe change up the format if necessary. So thanks again, guys, for tuning in, and good luck trading next week.